Hi, my name is Han Yan. I'm going to provide a series of tutorial video for my class Advanced Financial Management. Today, let's start from Chapter 1, Introduction to Corporate Finance. In Chapter 1, we will discuss 6 issues. The first is, what is corporate finance? And then we'll discuss how corporate firm is different from other types of firm, the importance of cash flow, the goal of financial management, and the agency problem. In the end, we will discuss the regulations related to corporate finance. So first, let's start from the first question. What is corporate finance? As we know, finance is about how to improve the efficient use of money and create more value. So, simply speaking, the corporate finance is about how to make decisions for the corporation to improve their efficient use of money and generate more value for the stockholders. The value created by a corporation could be reflected on the balance sheet. This is the basic format of the balance sheet. Assets equals to liabilities plus stockholders' equity. So, the job of the financing is to manage assets as well as liabilities and equity to generate more value. There are 3 specific aspects about financing. The first one is capital budgeting. Capital budgeting is about the lifestyle assets, especially to make and manage the long-lived assets, such as building equipment. I have a good example here. I think for Empire State University, we make investment to the renovation of our memorial unit. I think that is a capital budgeting. First, it is memorial unit, the building is a long-lived asset. Second, I think through the renovation, after this all kinds of renovation, more and more people from the Empire community will come to memorial union. They probably will rent our conference room or cafeteria to hold some activities such as conferences, wedding, or banquet, which will generate more revenue for our university. So I think it is a capital budgeting. The second aspect is capital structure. Capital structure is about the proportion of the right side of the equation of the balance sheet. It's about the proportion of the current liability, the long-term debts, and equity, how to distribute these 3 parts. And the third aspect is about net working capital. Net working capital equals to current assets minus current liability. And the net working capital focuses on to manage the gap between current assets and current liability. So this is some basic knowledge about corporate finance. Next, let's look at how the corporate firm is different from other types of firm. For example, sole proprietorship and partnership. Sole proprietorship is the most popular type of firm in the United States. However, the corporate firm, the corporation, is the most effective, it should be the most important type of firm for the United States because it generates the most revenue compared to other types of firm. And it is the most, and the corporation has the most effective way to raise cash. There are some obvious advantages for the corporation. The first one is the corporation is very easy to raise money by issuing stock to the public. And the second advantage is it is easy to transfer the ownership of the company. For example, if today we read the newspaper and we find out a company is very good and the company has great potential, have bright future, especially we like the manager. He is very knowledgeable, he's very humorous, he's very handsome, very capable. Okay, then we decide to buy the stock of this company. So we go to the stock market and buy some shares of this company. Then we have the ownership of this company. We own this company. Probably next year, for example, we discover there's some financial difficulty in this company and the manager is not attractive to us anymore. So we decide to sell this, the stocks of this fund, of this company. And so by selling the stock, we transfer our ownership to other person who purchase these stocks. So it is very easy to transfer the ownership. Therefore, there's no limited time for the corporation as long as the company should runs well. But for sole proprietorship and partnership, because the individual person owns the firm, so the life of the firm basically depends on the lifetime of the owner, the natural person, and it is difficult to transfer the ownership for sole proprietorship and partnership. Okay, next let's look at the importance of cash flow. The cash flow is very important because cash flow reflects the value generated from financial activity. If the cash paid to bondholders and the stockholders is greater than the money we raised in the financial market, then the value will be created. For example, today we borrowed $100 from the financial market and we promise to pay back $110 next year because the $10 is the interest. And then we use this $100 to make some investment. We buy some stocks or invest in some other places. Next year, this $100 turn out to be $200. So besides paying the $110 back, we generate $90 revenue. Let's see, we put this $90 revenue in the equity. So in this situation, the money paid to bondholders and the stockholders is greater than the money we raised in the financial marketing. Let's see, that's $100, or 1 year later, that's $110. So in this situation, we create value. Next, let's look at the goal of the financial management. The goal is very simple. The goal is to maximize the current value of the stock per share. But the simple goal is not that simple in reality because of the agency problem. For example, if I want to hire a lawyer to work on a case for me and I am the principal, the lawyer I'm hiring is agent. Sometimes we have different interest orientation. For the corporation, the shareholders elected board of directors and the board of directors selected the top management. So this is a kind of employment relationship. Sometimes the manager's best interest is not always the same as the stockholders' interest. For example, if the manager is only here for 5 years or 8 years, he or she, the manager, will concern in a short run, not a very long run, for the best interest of the stockholder. For example, if there is a very good investment opportunity right now, but this opportunity kind of have a little bit high risk, the manager probably want to avoid this investment because if it turns out to be wrong, which will affect the manager's future development, probably he or she will lose this current job. But for the stockholders, they will lose a very good chance in the long run because this opportunity will not come back anymore. So this is basically describe the agency problem. Okay, our last question is regulations related to corporate finance. There are 3 main regulations. The first one is Securities Act 1933, which is about issuing new securities. Security Exchange Act 1934, concerned about the insider trading. And the Sarbanes-Oxley was enacted in 2002 after a series of financial scandals at the beginning of the 21st century, which required that the company's annual report must have an assessment of the internal control structure and the financial reporting. It also required that it is the manager's responsibility, rather than the auditor, to make sure the accuracy of the information presented, shown on the financial statement. So these 6 issues basically cover the chapter 1. Chapter 1 just provide a basic information, a general background for the corporate finance, and we all know that the cash flow is very important. So in chapter 2, we will discuss cash flow in details, and we will learn how to calculate cash flows. Thanks for watching.